Okay, so good evening, all. We are looking at chapter one, or the introductory part of the syllabus. And if you look at the syllabus very well, you see that the introductory part is um, things that you have to do theoretically. What I mean by that is that they are not computational, so you are not doing calculations. And by the way, this a maximum of 10 marks are allocated to this section. So whatever you do here can affect you building up marks. And most times I tell students this is where you actually should start your exams from in order to build confidence while you proceed with the examinations, while you think about how to go ahead with the computations and complex computations. You should just start with this. So under this, we have the nature of the and business and purpose of the financial management. We look at that. We also look at economic issues. Essentially, these are the issues. Under the nature and purpose of financial management, we look at that. We look at financial management, its comparison with other courses you must have written, such as financial reporting and financial accounting. We look at the way financial manager is, or what financial management is, and we look at the elements that make up financial management. We look at the objectives of financial management. What does the organization intend to achieve by embarking on the management of its finances? We look at that. We look at economic issues. We look at economic targets. We look at the macroeconomy in itself, macroeconomic objectives, the targets, the policies, which are essentially monetary policy, fiscal policy. We look at how all of these interweave. So that's essentially what we are looking at. So we are starting with nature and purpose of financial management, like I said. And under this, under the nature and purpose of financial management, we are considering first financial management, financial accounting, and management accounting. So, well, financial management is a simple thing. When you say financial management, you are not saying anything that's different from business management or management. So if someone asks you any question like how you they do, you are most likely to say, "How I they manage you." What you mean by "I they manage you" is like you conveying to the person that you are making the most use of, or the best use of, the resources available at your disposal. So making the best use means like you are efficiently and effectively deploying the resources, in order to achieve whatever target you have set for your own self. And that's it for the organization also. When an organization is management in organization, we are saying that the organization is basically deploying its resources. When I say resources, we are talking about man, we are talking about materials, we are talking about machine, we are talking about money. The organization is deploying all of these in a manner that gives it the best or the maximum reward. Now, the reward is proposed by the organization, maybe at the strategic level. So, the organization is deploying these resources in order to achieve the best. So that means they must effectively deploy them, and that means, of course, they must efficiently deploy them. Effectiveness implies that in using the resources, the aim is achieved. So if, for instance, I want to travel from here to Lagos, whether I fly or I take the road or I use, let's say, the waterways, assuming there is one like that, and I eventually get to Lagos, I am effective because my purpose is achieved, my objective is achieved. If what the organization wants to have at the end of the day is, oh, let's have more revenue, let's make more sales, and it does so, that is fine. The purpose is achieved. But then beyond that is efficiency. Efficiency, which implies that the organization must do that by expending the least possible resources. So I want to go to Lagos, for instance, and let's say there are 2 or 3 possible avenues to go to Lagos, to get to Lagos through road. Let's say company A, all of them are transport companies, road transport companies. So let's say the first is suggesting, oh, the cost is 30,000, the other is saying 35, and the other is saying 40. And looking at it, there is no relative difference in terms of the comfort they all provide. And there is no significant time lapse. Almost all of them will arrive the same period. Like let's say it's 8 hours. All of them will arrive there in 8 hours, and they are all air conditioned and they drive very well. Everything is virtually the same, but then there is difference in cost. You don't expect an efficient firm to opt for the firm that will, or the option that will charge 40 or 35,000, because we are still going to achieve the same purpose at the same time without any significant difference. So for an efficient firm, you want to operate in a manner that grants you the most resources or takes from you the least costs. So let me use another instance. If two persons are to perform a given task and one person performs in an hour and the other person performs in 45 minutes, we can easily say that the one that performs the task in 45 minutes is the efficient one. So that's it. So when we say financial management, we are saying that we are talking about redeploying the organization's financial resources in a manner that meets the organization's nominated objectives. So we are effectively and efficiently deploying the organization's financial resources in a manner that provides the organization its nominated objective. We'll talk about that much later when we talk about financial management objectives. So that's it. Now, under financial management, there are three basic elements. First is the element of financing. Financing means that as a financial manager, it's your responsibility to look for funds, to look for resources, financial resources. When organizations say we have won a contract, we want to execute a project, how do we get funding? It's the role of the financial manager to seek avenues to get these financial resources available. That's the first one, which is what? Okay, so financing. In financing, of course, we talk about short and long-term financing. We talk about external and internal financing. We'll talk about all of that. So sources of finance is a topic we have to consider, a subtopic we have to consider. But prior to that, each of the financing alternatives has its own consequences, has its own benefits, and has its own burden. So, for instance, if there is an opportunity and we say, oh, let's borrow, fine, you can borrow. If you borrow, of course, the shareholders will be happier because tax will be reduced. But then, when you borrow, you commit the organization to financial costs. So there will be periodic financial outflow, which is an expense. Can the organization cater to that? Is the organization liquid enough to fund such disbursements to debt providers? That's a question that has to be answered. Or if you feel, okay, why should we borrow? Let's just, as owners, let's generate more money. Let's get more people to be part of this firm. So you issue equity instruments. Well, that is fine. You don't have immediate risk. But you as an owner, will you be able to relinquish parts of your rights? Because when you bring somebody in, you will cede part of your own rights to the person. Will you be able or willing to do that? That's a consequence that has to be considered. Aside that, when you get people to join and you increase the shares in the company, there's what we call dilution. That is, the average earnings per share will drop because the number of shares have increased. And probably the increase in earnings cannot match the increase in the number of shares. So you have the average earnings power dropping as a result of that. So these are just considerations that the finance manager has to make when financing. The other is investing. Like I said, we have financing. The other is investing or investment. It is the role of the finance manager to consider investment alternatives. Are we investing in the real sector or in the financial sector? Real sector means you are actually investing in manufacturing, production. You are rendering a service. That is real. In financial sector means you are either buying bonds or you are buying shares or you are buying one instrument or the other. you don't, or maybe investing in the stock exchange, which also implies just buying into companies, and you are not directly involved in production. So are we involved if investing in the financial or in the real sector? These have consequences, because if you're investing in the real sector, for instance, you have to consider things like investment appraisal. You have to consider that these are long term, so, or if you are investing also in the short term, you know that there could be risk related, although they are a bit moderated, but then the return may not be as much as. So, and would you want to just keep yourself in the speculative spectrum, or you want to invest in somewhere that you can relax and say you want to see your money grow over the years? So this is what the financial manager does. It can advise and where the organization can employ its resources, looking at the returns and the risks. So that's it. The next is, I talked about returns and risk, right? So returns. So you are not investing because you just feel like it's something worth the while. No, you are investing because you expect something in return, which is the return, which may be profit. So you expect an increase in value, and that's why you invest. And that's why you invest. So when this increase in value comes, what happens? What happens? You appropriate. So the third is appropriation. You are investing because you are expecting returns. So when these returns come, you appropriate. So the organization will ask itself, are we appropriating the entirety of the returns to ourselves? Or are we appropriating the entirety of the returns to the business? Or are we appropriating in such a manner that part will be for the business and part will be for us who have sacrificed our consumption rights, or consumption rights and opportunities, and we sacrificed it. So should we just, so that is a decision that can be made by the finance manager. And all of this, the choice in all of this will also revolve around the organization's strategic objective. For instance, if an organization seeks to grow, it means that they will appropriate more to the firm than to themselves, because they will need much more to reinvest in the business. So that's it. So what then is the difference between financial management and financial accounting, for instance? Financial accounting is essentially historical. It has to do with the moment an account is prepared, financial accounting is over. The moment you present, the moment you measure, the moment you recognize, and the moment you disclose, it is over. It's essentially historical. While for management accounting, and of course financial accounting is for a variety of users, it's aimed ultimately in producing information that will be used by users, various users. You have the government, you have the management itself, you have the shareholders, you have employees, you have analysts, you have the general public, that are interested in these reports. So that's it about financial accounting. Then management accounting is essentially at the discretion of the organization. Management accounting is just interested in providing information, accounting information, cost-related information to management in order to aid decision making. That is it. That is it. So that's the difference between all of these, essentially. So you should know this. So the next question we are addressing is, what are then the financial objectives of the firm? What are the financial objectives of the firm? Let me say this. The financial objectives of the firm are not divorced from the organization's own objectives. So if the organization has a strategic objective, the financial objectives should be tied to the strategic objective. So for instance, I said earlier that if a firm wants to grow, for instance, they may retain more of their earnings while they appropriate little relative to what is retained to its shareholders. The reason for this is because they want to grow. So you see that the financial strategy of how do we handle appropriation is tied to the corporate objective. So that's it. So there are so many financial objectives. For instance, we have stakeholder value creation, we have shareholder wealth maximization, profit maximization, we have earnings per share growth, Remember, I talked about dilution. That's where it comes to play. We have liquidity maximization, we have stability, and we have growth. These are objectives your organization can, financial objectives that the organization can pursue. So, what is shareholders' value creation? When we say shareholders' value creation, we are considering first the interest, the divergent interests and interest of the various stakeholder value creation, sorry, not shareholders. So you are considering the divergent interests of the stakeholders, of the different stakeholders, and you want to see how you can align them. If you can't, you want to see how you can at least meet the interests of these stakeholders without jeopardizing the going concern or the interests of the organization. So for instance, like I said, we have government. Governments have their own interests, which of course will be ultimately to get revenue from the organization, but they are also interested in the welfare of the organization. They are also interested in ensuring that the business continues. Of course, their long-term interest, which is to have revenues from the organization, is tied to the existence of the firm. So they wouldn't want the firm to collapse. So you have these different, you have the shareholders, you have the employees. If you pay employees so much, managers may not even interestingly, they may not even be happy because it will project their own performance as not being good enough. It will seem as though they are not churning out good profit for the firm. But you can imagine their own interest is to ensure that aside ensuring that the organization performs well, they want to earn as much as possible. You see the issue between management and employees. Employees will want to have money. In fact, employees will possibly want to earn all to have all the earnings of the organization transferred to them, and possibly even just go on vacation. So they will be negotiating a whole lot about their welfare and their pay. So that's it. So conflicts there. So that is about shareholder value creation. You want to see how you can harmonize or you can meet the interests of these different stakeholder groups, which of course may also include the community. So that's it. So advantages, or it will lead to improved organizational reputation. If you meet the interests of your stakeholders, nobody is taking you to court, nobody will be at your gate, nobody will be there to lock up your premises. Maybe the government or the community, the employees will not go on sudden, or even if it is programmed industrial actions and all of that. So the organization will move smoothly, operate smoothly. There will be stakeholder value propositions. They can propose, they can give advice. That's what I mean. So it improves the risk management by mitigating risk even before they arise. You don't wait for employees to go on strike or industrial action. You take actions before issues like that crop up. So that's it. But the challenges is effectively managing conflicting interests of different stakeholders. Recall that of the management and employees, that of shareholders and government. If you pay government too much tax, you are giving less to shareholders. If you are pursuing the interests of shareholders exclusively, you are jettisoning that of the government. So you see how do you manage this conflicting these conflicting interests. So these are some of the few challenges. You have difficulty in measuring stakeholder value creation. How can you measure the value that is created, for instance, by government? How can you in this economy? You know. So then the next is shareholders' wealth maximization. This, let me say this and let me emphasize, this is the number one financial objective of the firm, to ensure that the shareholders' wealth is maximized. And the way the shareholders' wealth is maximized is by ensuring that the shareholder has as much dividend as he possibly can, and also to ensure that there is capital appreciation. Capital appreciation means that if a shareholder buys your company's shares today, maybe 15 naira, it should be rising. It should be rising. So it shouldn't be stagnated at 15 naira. That is That is it. That's shareholder wealth maximization. So, like I said, this is the ultimate. It provides a clear objective for the organization. It encourages effective allocation of resources. You know, the moment you hear that a company has completed a project, it has won a project, they are constructing a facility, they are done. These are investments that can lead to interests by potential investors and increase the value of an organization. So that's it. So, but the challenges, there are some challenges. Determining the best measure of value. What's the best measure of value, for instance? How do you measure value? Is it the future or the present value? How do you? So that's a big challenge because sometimes value itself can be subjective. So the next is profit maximization as a financial objective. This, arguably, this is what came to your mind first, but I've told you that shareholders value maximization is the top one. So how does this work? Profit maximization. We intend that, you just want to increase profit, the organization profit. But there are issues with this. First, profit is short-term. Profit is short-term. Profit is historical. Profit is about the performance of the last year. It's possible that the current reality is far, 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 far different from, you remember, 2023, the president came on and he said fuel subsidy is gone. Companies that are firms that have reported good performance the year before, companies that people had invested in thinking that, oh God, this is very, very good. They went through hell. Some companies lost so much that they even left the country. Now, if you relied exclusively on the financial reports of the preceding year or the previous year, you will discover that your decision is wrong because currently, when you are making your decision, they are going through terrible times, but you are relying on a history of good performance. So profit is short-term and profit is historical. And profit can be deceptive, for instance. In accounting, what is profit? When you say profit, are we just saying gross profits, net profits, profit before tax, or profit after tax? Are we talking about return on assets, return on investments, which is ROCE? Or what is the fine definition of profit? How do you define profit? So profit can also lead to sacrificing long-term intentions for short-term gains. If a manager sees that, his assessment is based on profits, he will just be interested in delivering profits even if the future of the organization is compromised. Yeah. If it is possible for him to invest the corporate funds in a financial instrument and forget about the core objective of the firm, in as much as that investment in financial instruments gives him more, he may want to compromise that, So profit isn't the best. It is, not the best measure of an organization's performance. I think in talking about this, I've talked about its advantages and challenges in one breath. So earnings per share growth as a financial objective. Here, the organization interest is our earnings should just grow. And your earnings growth will imply that, one, either your profit is rising relative to or rising faster in relation to your number of shares outstanding. Your earnings are increasing at a higher pace. That's one. Number two, you may even talk about shares buyback. That is, the organization consciously tries to reduce the number of shares. So that's it. So, and it gives shareholders wealth growth it results in shareholders wealth growth over the long term. So it ensures higher retained profits for reinvestment. So this is it. Liquidity maximization. Liquidity maximization objective revolves around ensuring that the organization is stable in terms of cash, in terms of liquidity, and that the organization doesn't commit itself to risk, and the organization doesn't get itself involved in obligations that they cannot settle. So, but the problem with this is that if you maintain high liquidity, you sacrifice profit opportunities. because there's a trade-off between profit and liquidity. The more profitability you seek, the less liquidity you have. The more liquidity you seek, the less profit you have. For instance, if you have huge cash or money in the bank, you are liquid as a firm, fine. But then these are monies that could be invested to bring about profits, which can lead to profitability. But because the organization prioritized liquidity, these funds are invested. They are just kept in the bank. So that's it. Next is stability. So for a stability looking, an organization that seeks stability, I can literally compare it to cash cow in BCG matrix. So this is a firm that is not seeking expansion. Maybe the market is saturated, so there is no point expanding anymore. They are just there. They are no longer advertising. People just know them. So the implication is that since they are not investing in plants, in machinery, in building, in PPEs, they have so much money. So what do? They have so much to cater to dividends. So all they are doing is make profits, declare dividends, share the cash to their owners, and that's it. So payments of adequate returns to debt providers is not also a problem. So they have enough cash, they can meet the obligations of their obligations to debt providers or debt providers or funds providers. So that's it. The next is growth. Like I said, for an organization that is concerned with growth, you want to expand, you want to increase the markets you operate in and all of that. You have so much to invest in. You have so much expenses to incur in terms of promotion, sales promotion, market expansion, and all of that. So you are researching and all of that. So this kind of company needs so much funds. So the financial objective, the financial strategy for this will be you retain so much, you seek external funding, and all of that. So that's the financial objective as regards this. It will also be important for us to look at these stakeholders and their objectives. We have talked about stakeholders. This is a critical area I can also raise these questions from. So it is examinable by your examiner. So we are saying we have stakeholders. So who are stakeholders? Stakeholders are groups that can be affected by the organization's operations or performance. Groups that can be affected by the organization's operation or performance. So operations or activities. So your performance, what you do, your activities affect them. So for instance, you have the community where you operate. If it's not noise, perhaps it's the environment you pollute, the air you pollute. So if it's not the air, you see vehicles moving up and down around that environment, risk for accidents. If it's not that, so there is a way or the other that the business affects the community. You have government. Government is an essential stakeholder. You operate within a place governed by laws. So you use resources provided by government, such as roads, electricity. In Nigeria, I don't know anyway, but well, they say make we teach, and that is it, and that's what we will teach. So that's it. You have roads, that's government. You have employees. You affect employees. There are certain jobs employees get themselves engaged in that can pose hazards to them. But whether it poses hazards to them or not, you are also getting them away from their social life. To get employees away from their families and all of that. So these are, you have management, you have shareholders, you have the community, you have trade payables, that is people you owe, long-term and short-term payables, customers, host community, management, the society as a whole constitutes stakeholders, and all of these have different interests. For instance, for shareholders, they provide the funds that the business use. And of course, they are the ultimate risk bearers. If the company goes down now, yeah, you lose your job, but they lose much more than your job. They lose all the monies they've invested in the business, not your own money, theirs. So that is it. So their interest is to ensure that their wealth is maximized as captured in the financial objective, wealth maximization, shareholders' wealth maximization. So, and this is achieved through embarking on risky investments such as the firm. The second is management. Management is led by a board of directors and senior executive management. Their interest in the organization as a whole would be advancing their career. So management wants job security, and oftentimes you see conflict between management and shareholders because shareholders by nature are risk takers. So when management sees an opportunity to invest in, even when the NPV is positive and it's an investment they should take on, if it is too risky, management may not want to because they are also considering their own job security. These are some of the conflicts we'll talk about. While the shareholders will want them to take that risk so that they will have more returns because higher risk will lead to higher returns. Management will want to hold back and say, no, what if we lose out on this deal? It may affect our own job. So that's that for that or about that. Then the next is trade payables. Trade payables are people who sometimes provide credit financing. You go to Aba, you travel with 50,000 naira, but you go home, you come back with, or you return with goods worth 70,000 naira. You know, be thief. They owe somebody. And that person is somebody that is a stakeholder in your business. The person wants your business to go on because the moment your business goes down, his money also goes down. So what's the interest of this person? You should have sufficient cash flow to return, to pay. So that's the interest of this particular trade payables. So the next is long-term payables. Maybe you invest in, you sought for people to provide bonds, you took loan from the bank. These are people that are interested in your business. They wouldn't want your business to go down because they want consistent flow of interest from you to them. And then they also want to ensure that at the end of time, you are able to provide the principal which you provided ab initio. So these are them employees. They want the best possible treatments. Treat them very well, pay them well, let them go on vacations in Barbados, in the Caribbean. Fine. This is their interest. Take care of their families, provide HMO, everything on you. So that's it. For the government, theirs is to provide enabling environment for your business to thrive. As a result of that, they want to ensure that they get money from you and call it tax. They want to get money from you and call it tax. Sometimes they can provide, of course, subsidies also, but then the ultimate interest is to get money from you and call it tax. So that's it. For customers, they have their interest is to ensure that the goods and services they get are goods that's worth buying. So it grants them value for their money. So they wouldn't want to see themselves as being irrational or people that have taken up wrong decisions. So they want the best possible satisfaction from the firm. So they want to optimize their expenditure. And of course, if you don't, customers can take actions such as brand boycotts, which might be used to influence the firm's decisions. Personally, I'm considering that anyway with a particular service provider. This South Africa thing. I was considering something like that. So that's it. Then the next is host communities. Host communities will come your gates, come knock or beat drum as they do around River State. If you know agree, go agree, kind of. So they may come and disrupt your operations by just getting to make noise and attract unnecessary attention to you and stall your operations. Then the society as a whole, the air we breathe, the environment we live in, the noise we hear, the water we use, the company's actions may affect them. So human rights groups, social welfare and environmental protection groups or campaign organizations may come and raise their voices in order to ensure that the organization's performance doesn't actually um, disturb or distort the environment itself or the society itself. So there are certain conflicts. Now, in the examination situation, ICANN may just throw at you two or more of these stakeholders and ask you questions like the kind of conflict that can arise amongst them or between them, depending on the number, and how such conflicts can be resolved. ICANN can raise such issues. ICANN can ask a question, oh, what kind of conflicts can arise? Of course, ICANN, they will like plenty talk. After they talk, what kind of conflicts can arise between the shareholders and the management, and how can such conflicts be resolved? So, first, we are looking at shareholders. But first, what I will tell you or what I provide is not exhaustive. Ultimately, it is incumbent on your knowledge of these stakeholders, one, their interests. From that, you will be able to know, to determine the kind of conflict and come up with how to resolve such conflicts. Oh. So, shareholders and management first. Of course, I've already told you, shareholders are risk takers. Shareholders look at the long term. Management may want to avoid risk. Management, they are interested in delivering profits now. So a manager knows that he may not be in the organization for 70 years, for 30 years, for 50 years, maybe 5 years. So if he knows that it's going to be 5 years, he just wants to ensure that he takes actions that will make his 5 years record be very, very good. What if what he's doing will make his 5 years record to be very good, then the years after, the organization will have interest. So we have issues. So that is the issue between shareholders and management. Shareholders are looking at the long run or the long term. Shareholders are looking at making so much returns, which means taking so much risk. Management is considering short run. Management is considering making as much profit as possible in the short run. And management is not interested in risk. So that's it. So this kind of conflicts may arise. And this kind of conflicts are arising because of agency problems, which we'll talk about. But for now, agency problem because I set up the business, I employed somebody to work on my behalf. That person is an agent. The person is working in my interest, only in my interest, not even part of my, no, it's working only in my interest. And that is why we pay. I pay the person. So there can come a time where the person starts working in his own interest. And that is a conflict or a problem. So how do we resolve these issues? We talk exhaustively about them when we consider agency theory, agency problems, agency conflicts, and how to resolve agency conflicts. We'll talk about that. So first, but then in order to mitigate this kind of conflict, shareholders may, or the principal may, of course, exercise the power to appoint and remove directors. They may do that. They may exercise the power to ratify or revoke decision by management. They may exercise the power by providing rewards in form of executive share option schemes called ESOPs. So in order to ensure that this manager works in my interest, I can tell him, oh, fine, I'm not looking at this company every day, fine. But then I want you to also be an owner. I will give you shares. If I have 80%, I'll give you 20% shares. Please buy 20% into this company, and you are paying me less than what you should pay. So commit some of your own resources and be a part of this business so that you will not compromise the going concern of the business or the objectives of the business, the long-term objectives of the business. So that is it. We also ensure, they can also ensure audit effectiveness through audit committee. All of these can be done in order to ensure that management ultimately works in the interest of the shareholders. There can also be an issue or a conflict between the shareholders, the management, and the long-term creditors. How can this occur? For instance, management strives to maximize shareholders' wealth through taking risky investments using money belonging to long-term creditors. So management will commit, for them to get money, they will commit resources owned by shareholders. They will commit these resources to long-term creditors like banks in order to raise money. Then fund providers rely on the company's earnings generating potential. So that's number one. When they invest ultimately and they get money, shareholders will want that money. But that money will first, even before they think about the management or the managers think about the shareholders, the monies raised will first be committed to the funds providers. So if the company's assets, I commit them to the bank and I got money from the bank. I do business with that money I got from the bank. And the profits, instead of me ultimately falling back on to the shareholders who provided the assets and prioritizing them with the appropriation of the monies I got, the returns I got through the investment, I will first be committed to the funds providers, to the debt providers, to satisfy them, to repay them first before I consider. So the assets are normally pledged as security for such loans, giving the right of ownership to creditors in the event of default. So management is using the property of the shareholders and pledging it to the fund providers. If there is any problem, maybe by way of credit default, the funds providers, which is the bank, will lay hold on the property of shareholders. Why not the property of management? So there is a conflict. The monies provided by fund providers are invested to earn profits. Every incremental profit increases the dividends of equity investors. So bank provide money, use it to do business, you make profits, you give them their paltry proportion, and you give the rest to shareholders. The shareholders provide this money. So these are possible conflicts that can arise. There's also that between shareholders and management, shareholders and government. I've talked about it. The more you give to government means the less to shareholders. The more you give to shareholders means less to government, or vice versa. So that's a conflict amongst them. So all of these are born out of agency theory. And agency theory has been examined several times. It just describes a situation where the relationship between the management and the shareholders is brought together. So agency theory is just talking about the relationship that exists between the shareholders and the management. Generally, you know that, like I said before, the business is owned by the shareholders, but the right to run this business is handed over to professionals. A shareholder may just be somebody that knew nothing about organizational management, probably hasn't been able to manage his family. So, and it's his wife that manages the family. So, since he can't run a business, but he can set up, he has the resources to set up a business. He has set it up. He has put people in charge to run the business. Now, these people they are running the business. He's paying them so that they run the business in his own interest. But then, at some point, they may begin to run the business for their own interest. So this relationship amongst the shareholders and the management is what brings about this agency theory. In this relationship, the shareholders are the principals, while management is the agent. Management acts in the best interest of the shareholders. So that's it. So agency theory describes the relationship between a company's owners and its managers, where the owners appoint the managers as agents to manage the company on their behalf. Full stop. So that's it. So, like we said, the agents or managers should be acting in the best interest. But then, like I said, also, they may not want to do that because of certain reasons. And this will eventually involve agency conflict or agency problem. The reasons that can cause this are first, moral hazards. Moral hazards. If you employ somebody to run your business, he may run it in a manner that you may not want to run his own. This is what I mean. You employ somebody to run your business. The next day, the business is struggling, but he's talking about, oh, I want to go on vacation. I want to go on leave. I want my salary to be increased. You ask him, assuming this business was your own, would you want your salary, the salary of your own manager to be increased given the way the organization is performing? So that kind of situation is called moral hazard. This is a situation in which the managers want to enjoy perks, the privileges associated with such a position. They want it all. They want it all. They want it all. So that is called moral hazard. They want gigs, they want accommodation, they want vacation, they want sponsored events, etc. and etc. So these are generally called moral hazards. It will lead to agency conflict. Next is effort level. Your own are your own. There is no man where you go put in charge to work for you. You go work the way you ordinarily go work for yourself. Napoleon Bonaparte, I think it is that said, if you want anything done well, do it yourself. If you want anything done well, do it yourself. No send somebody. But then, sorry, you don't have the capacity. So somebody will want to do it the way the person wants to do it. So effort level is another issue. Earnings retention. So bigger firms generally pay managers better. Therefore, to grow the firm, managers retain profits rather than pay dividends to shareholders. But you want growth now. You say you want growth. You want your company to grow. It means you will not be having what? You will not be having dividends. But the manager himself will pay himself in your salary and all the things he need to pay himself. He will not say, okay, for the organization to grow, I want to earn lesser. No. You want to earn as much as he can get. Then risk aversion. So I've told you before, to ensure that they don't lose their jobs, they won't want to take risk. That risk aversion is a conflict situation because because shareholders themselves will want a situation where the organization takes risk in order for them to have more returns. Next is time horizon. Shareholders want long term. Managers want to be looking at the short term. So, in order to ensure that you solve this agency problem or agency conflict, you want to align your own interest as a business owner to that of the business manager. So the shareholders will want to align their interests to that of the managers. To do this, there will be certain costs called agency costs. Now, agency costs are generally in three perspectives. One, we have the monitoring cost. Two, we have the opportunity cost. And three, we have the bonding cost. We have the monitoring cost. You have to put people on ground. If you have a manager, you have to put structures on ground that will monitor him directly or indirectly. You have records where he will write down whatever he does. Maybe you put CCTV camera in your shop or in your business premises. Maybe you have an auditor. Maybe you have a lawyer. All of these things or persons are to ensure that eyes are always on him so that he does what he should be doing, which is to seek your interest and work for that interest. So you have monetary. Then you have opportunity costs. So opportunity costs. So there are certain losses their shareholders will make. They actually lose value in a move that, in order to enhance the portfolio of management. For instance, if the firm acquires another, management shareholders may not be even present when a decision is made for merger. They may not even be there. You know. So, but if the firm talks about acquisition and acquires another firm, the acquisition premium that is paid for the acquired firm means that shareholders will lose their value. So, if you are buying a firm, you must pay a premium. If you are marrying a wife, for instance, you will pay much more than what you should pay because people are sacrificing, or she's sacrificing her comfort. So if ordinarily what she's worth is 5 naira, what you pay will be like 6 naira in order to take care of, in order to cater to the extra sacrifices the person is making. Now you are paying more. So the emphasis is that the management may entangle the shareholders in a situation that will make them lose value. And that opportunity and that situation is not created by the shareholders themselves, but by the managers. And that is opportunity cost. And that is some kind of cost to the firm. Then there is bonding cost. For instance, you want to ensure that you are aligned, your interests are aligned. You want to ensure that that manager, if he paints you, he also paints himself. If he hurts you, he also hurts himself. So what do? You also make him to own shares in the company. You tie his interest to that of your interest. You, for instance, you say if the organization makes so profit, then you will give him so thing. Or you tell him, oh, I'll give you bonuses, I'll give you executive share ownership opportunities. So ESOPs. So these are costs on the firm. These are costs on the firm in order to ensure that there's alignment between that of the management, the interest of the management, and that of the shareholders. So that's it. To achieve this, the organization may talk about or consider providing a remuneration package for senior executives, that is senior managers. Then you can give them share awards, like I've said before, ESOPs, which is just award shares to them. They are not paying. Then you have ESOPs where they buy shares at subsidized prices. That's it. The next is for us to look at corporate governance. Corporate governance is a critical thing in this. It has to do with how the organization is managed on behalf of its owners. The owners of the business are not present in seeing or monitoring the daily operations of the business. So they are shareholders. Some of them are abroad, some of them are in their villages, some of them are retired. They are not there in the firm. They don't know what's happening. But how do we ensure that the organization is run in their best interest? That is what corporate governance is concerned with. And in order to ensure this, under corporate governance, there must be board. There must be board. The board where the representatives of the shareholders are present and they make valid input to the decisions of management or of the organization. So management isn't just making or taking decisions. These decisions are being screened by people who represent the shareholders who are not present. But so that's it. Now, this board, its composition is vital. To compose a board, at least 50% of the members should be non-executive directors who may be independent or who should be independent. These supposed independent non-executive directors are not members of the organization. So they are not part of the organization. They are not even shareholders. They are not part of management, but they are there essentially to represent the shareholders. So the composition should be such that at least 50% of the members of the board are these non-executive members. This board should also be such as it is headed or chaired by a non-executive director. not an executive director, but by a non-executive director. The board should be such that it is refreshed periodically, that is, people are added and people exit the board. So it should be refreshed. It should also be highly diverse or diversification, or having a diverse board means you have people with varied experiences. You have people, young people, who can, if they are discussing things that contemporary things among the youth, you have somebody that can raise a voice or lend a voice on it. If you are talking about things that relate to experience, you have people there. If you are talking about things that women should be passionate about, you have there, as women, you have men, you have people across different fields: engineering, finance, law, biology. So you have well structured, well represented, well composed. So you should have that. Then the board should also be concerned with the remuneration of directors. How much I cannot employ myself and begin to set salary for myself. I cannot be employed and I set salary for myself. People that employ me should be the people. So shareholders are the people that employ the management or the managers. So the shareholders should set the salary, and that will be done through the remuneration committee. Then we have internal control or internal control related issues by the board. So the audit committee is critical to internal control issues because they oversee the auditor, they appoint the auditor, they oversee the audit process, external audit process, and the auditor most times will look at the situation and raise internal audits, internal control issues. So then we have our external audit. I've talked about that. Elements, as part of the elements of corporate governance, is external audit, and that is being handled by the audit committee. Then we have communication between the company and its shareholders. So the board stands in between. They represent the shareholders, like I said, and they tell the shareholders what the organization is doing and convey the aspirations and thoughts of the shareholders to the board also. So we'll have to stop here. When next, in your next video session, we'll talk about corporate governance and agency problem reduction. How do we reduce these agency issues relating to and corporate governance? So till then, bye bye and have a wonderful time.